In my last chapter of the book, I recommend buying and holding the TQQQ. And the reason I mention it is because the tremendous performance it has had over the years, knowing that it had huge drawdowns, but I mentioned only put a small percentage of your money in if you're interested. Well, I think you should just be careful, know what you're getting involved in, never buy anything that you're unsure of, do your own thing, consider ETFs. Just be aware of the fact that we have bull and bear markets. I like trading the TQQQ. I use MACD. I use RSI. I use CCI. And then on the chart itself, I have the 8 EMA, the 20, the 50, and Keltner Channels, and volume weighted average price, the VWAP. And I use a chart, 1 minute chart. In my world, for me, 5 minutes is long term. The TQQ has a 0.84% expense ratio. Currently, their assets under management are about 26 billion, which is only less than a tenth of the QQQ, but it's sixth in trading volume, 53 million shares a day for the TQQQ. And since February 10th, 2010, when it first came out, it's up 23,912%. I don't want to waste 1 minute doing a lot of things I don't want to do, because I believe everything is embedded in the price of a stock. Every time I read something from the Wall Street firms, don't time the market. Everyone says, 99.9% say don't time the market. Well, what's your other option? Buy and hold? Fine. If you want to buy and hold for 30 years and you want to buy index funds, that's one strategy. But if you're in the market and you want to do other things and you don't have that longer time frame, you better market time, because you're going to take some big hits when bear markets hit, unless you have a strategy that gets you out.
Hey everyone, welcome back to another episode. As always, we bring top traders, US investing champions, and market wizards here onto the show to share their journeys, their strategies, the mistakes they made throughout their careers, and key learnings that they want to pass on to you guys to save you time, save you money, and improve your performance. We've been lucky enough to hear back from many viewers over the past few years about how much of a positive impact this podcast has had on their trading journeys, and we're incredibly grateful for all the support. If you're looking for a free, quick, and easy way to give back to us and show us some goodwill, please double check that you're subscribed down below, and if you aren't, go ahead and click that button. This helps us out in two ways. First, it lets YouTube know that this is a valuable resource and it'll push it to a wider audience of traders. And two, it allows us to reach out to bigger and better guests in the future. So thank you so much for your support in advance. Also, go ahead and click the like button if you haven't already. And if you have any suggestions for traders you'd like us to bring on the show, also let us know down below in the comment section. And with that said, thanks again for your support, and sit back, relax, and enjoy. All right, welcome back everybody to the TraderLion podcast. I'm your host, Richard Moglen. Joining us today is Les Masonson. Les is a trader, author, and researcher with over 50 years of experience in the markets. He has been a columnist and contributing writer at Technical Analysis of Stocks and Commodities magazine for nearly a decade, and holds a BBA in Finance and Investments, along with an MBA in Operations Research with a master's thesis titled A Statistical Evaluation of the Relative Strength Concept of Common Stock Selection. He also most recently published his 7th book on the markets, which shares his research on TQQQ and leverage ETF strategies, titled the QQQ and TQQQ Profit Machine. Really excited to dive into his key insights and hear him share his research here today. So Les, thank you so much for taking the time, and welcome.
My pleasure, Richard. Thank you very much for the opportunity, and we hope that your subscribers and the individuals who watch this video take away a lot of useful information today.
Yeah, we're going to cover a lot, so I'm looking forward to dive right in. And to bring it back to the very beginning, I'd love to hear kind of how you first got interested in the markets, and then I'd love to hear the origin story of how you first got involved with trading leverage ETFs, and specifically the TQQQ.
Okay, well, it's a long story, which could take about 3 hours, so I'll encapsulate it in about 5 minutes maximum. It was a random event that really got me involved. Back in 1957, a long time ago, when I was 13 years old, my grandmother gave me a share of Pan American Airways stock, and that was my first introduction. So I said, "What is this?" And she told me it was a share of stock. I said, "Very interesting." And then I decided to go to the library, and I took out a number of books, and I learned about the stock market. There's only about 3 to 4 to 5 books at the time. And then I was living in Brooklyn, New York, and I decided to go to the large library in Grand Army Plaza in Brooklyn, which was a huge library, and I got a few more books there, so that turned out to be very well. And then I decided to make a big purchase, so I purchased 4 shares of Chock-full-o'-Nuts. It was a coffee restaurant chain in New York City. I purchased 4 shares in probably early 60s, $28 a share. It went up to 104. I said, this is terrific. It ended up at 28, and I sold it back at 28. So that was my first lesson, and it was pretty sad situation to lose what I had gained. So I learned a very quick lesson. You better be careful about what you hold, and you better make sure that you protect it against collapse. And a lot of people failed to do that, in the dot-com bubble, but they learned a hard lesson. And I also started watching Wall Street Week with Louis Rukeyser. That show came on the air in November of 1970. And I started watching Nightly Business Report on PBS in 1979. And also during my junior high school years, I took the subway from Brooklyn to Manhattan, and I visited the New York Stock Exchange Visitors Gallery and the American Stock Exchange Visitors Gallery. And I wore a sport jacket, tie, and slacks, and I visited my brokerage firm, Winslow, Coe & Stetson, at 15 Broadway. And I went into my broker's office there, and at that time they had the stock tickers on the wall, but there was a machine where all the digits turned to an electronic machine with all the digits moving. They also had a ticker tape in a plastic container on the side, and they printed a ticker tape, and the ink was purple ink, and it showed you the number of shares and the price going by. And at that point, they had something called the pink sheets, which was actually pink paper with low-price stocks on it, printed out. It was about 6 inches high. And they also had the S&P 500 guide, which was a booklet that came out every month by S&P, and it showed you the earnings and things of that nature. And then I was reading the Value Line Survey back in those days at the library. So that's what the beginning was. And then I have a long career in banking. I was involved in the banks down on Wall Street for a number of years in bank operations, in cash management consulting. But over this time, I was continued to read books, learn for myself. I like technical analysis very much, so I subscribed to a number of services like stockcharts.com and others over the years and became very proficient. Basically, I'm self-learned. Mm-hmm. And when I got to get my bachelor's degree, I started with City College of New York, electrical engineering, and I lasted 1 year before I knew what hit me. I didn't know what hit me because I couldn't understand a word of it. So I ended up in the Baruch Business School, where I knew I should have been in the first place. And then I took my accounting and finance and investment courses there. But I knew most of the stuff in the investment side because of my prior book knowledge. So that worked out very well. And when I left, when I got my bachelor's, I took a 1 year or 2 year. Well, actually, it took me 5 years to get my bachelor's because I lost a year with the engineering. But they gave me enough credits, so it wasn't a problem. And then when I tried to work on Wall Street in 1970 to get a job in some research department, they were firing people at that time. So I ended up at Irving Trust Company, which was a big bank at the time. The address is the greatest address in Wall Street. It's 1 Wall Street, right at the corner, across from Trinity Church. And somehow a different department got my resume called the Quality Control Department. And they said, hey, you have a degree in advanced statistics. Why don't you come work for us? And that's how I ended up at Irving Trust, evaluating the check processing operations and improving the throughput of the machines, etc., and magnetic ink at the bottom of the checks. We did testing on it. And then I started managing a number of different departments, the records department, the federal funds department, where we issued wire transfers all across the globe for our customers. And then after about 7 years at Irving, I decided I wanted a career change, and I wanted to go into corporate cash management, which means dealing with companies who have relationships with the bank, and then we were called in to help them in their treasury department, improve their cash flows, looking at receivables and disbursements and concentration of funds and electronic funds transfer. So that's where I got started in corporate cash management. I lasted 2 years at then I went to, after Irving, I went to Bank of America for 2 years. They had an office in Manhattan. They had no branches in Manhattan at that time. They were strictly a specialty bank. They had an office on Park Avenue, no branches at all at that point. So, and it wasn't, they didn't have that many big useful clients because they had to compete with all the other New York banks at the time. So I decided to jump over to Citibank, which was one of the top banks in the 80s and 90s. Walter Wriston was the president and chairman. He was a terrific president. And I did cash management consulting at Citibank for 7 years with large companies like General Motors, Beaumont Hospital, Citicorp Diners Club. And we saved these companies a lot of money. And that's why they gave us a consulting fee, which went to the bank. So that's how that worked. And then I decided after a while to become a financial advisor. And that happened between 2004 and 2010. I took my licenses, Series 766, and the health license. And at that point, my last book was coming out. Buy, Don't Hold was coming out right after that. So I just decided to leave the bank before they gave me a hard time, because they don't like you writing about the market if you're there doing work for them. So I decided just to resign at that point and not get involved. And then I started day trading, TQQQ, and I did that for many years. And then I started with the NASDAQ E-mini futures, and I've been doing that for the last 5 years. And the reason I day trade is because I don't want any overnight risk. Because you can wake up one morning and it could be October 22nd, 1987 repeated.
Yep.
I don't want to be there. But everyone does their own thing. That's why it's a beautiful place. Everyone has a different strategy and do different things. And even if you look at all the traders out there and all the traders in Schwager's book on the market masters, they all have a different story. They all use a different approach. Some use fundamentals only, some use technicals only, some use a combination, but everyone has to find what they feel comfortable with. So that's the short scoop on where I am.
Perfect. Well, you've done it all, so it'll be great to pick your brain and hear from your experience. And I also wanted to hear specifically, obviously you started day trading TQQQ. What kind of sparked your interest in that in that investment vehicle in the first place, and what made you decide to actually write a book about it?
I'm very aggressive in my investments, and I've been reading about the ETFs since they came out in 1999. So I just found by being on the internet, by reading a lot, and that's one thing I do. I have a personal library here of 500 books on technical analysis, trading, psychology, and things of that nature. So I like to read, I like to learn. I spend at least 2 hours a day on the internet reading about ETFs, because I'm the ETF columnist for the Technical Analysis magazine. And I have to write a column, 6 columns a year on ETFs, so I want to be up on things. And I just have an interest in that field. And TQQQ seemed like a great vehicle to do it with, because basically, if you wanted to use $10,000 to invest in QQQ, you can use 1/3 of it and do TQQQ.
Right.
But you have to be aware of the fact that the maximum drawdown is huge. So that's why day trading is one way to approach it. Of course, you can do swing trading and position trading, take the overnight risk, which is something that is substantial. But in a bull market trend, and you can stay in long enough and you have your stop rules, you can do very well. So I decided to do a day trading scenario. I developed my approach, which uses technicals only. I don't use fundamentals. And one thing I decided early on, I don't want to waste time trying to find which are the best stocks to trade each day, and then have to do fundamental analysis, listen to what's going on, listen to all the industry stuff. I don't want to waste 1 minute doing a lot of things I don't want to do, because I believe everything is embedded in the price of a stock. There are, of course, insiders who know maybe when better to buy, but they may end up in prison if they spread around the information too much. So it's important to focus on what you feel comfortable with. And I like trading the TQQQ. I use MACD. I use RSI. I use CCI. And then on the chart itself, I have the 8 EMA, the 20, the 50, and Keltner Channels, and volume weighted average price, the VWAP. And I use a chart, 1 minute chart. In my world, for me, 5 minutes is long term. So people would laugh at that because some of you people use 30-minute charts or 1 hour charts. So I use 1 minute charts, and then I have some 5-minute charts. And when everything lines up, where the indicators are below or above overbought, oversold levels, and the Keltner channels are pierced above or below, and the 8 EMA is the critical number, which I know is used by a number of people, and it seems to work very well. Actually, I can show you a chart at the right time of an 8 EMA. I don't know if you want to switch to a chart at this point, but
well, first, I want to come back to that for sure,
okay.
for less. But going back to one thing that you said, which I think is really critical when it comes to why traders would be interested in the TQQQ, is what you said about you don't want to waste time having to look up all the fundamentals and do all that research when during an uptrend, the TQQQ will outperform the majority of stocks in the NASDAQ and S&P 500 as well. You talk about in your book, and I know you actually interviewed who I initially learned from, Dr. Eric Wish,
right.
And he's done a lot of research about during uptrends, why not build a position in the TQQQ as at least a portion of your portfolio, because it does tend to outperform so much. So I'd love to hear kind of your take on that aspect of it.
Okay,
how does the teachable? Yeah, please. Go ahead.
I can share a screen with you.
Yeah, that'd be great.
And I'll show you what I have. What I want to mention is the fact that if you rank the NASDAQ 100 stocks each week, TQQ will come up near the top if we're in a bull market. And if you happen to be in a flat or sideways market, TQQ decays very rapidly. So if you're in a bull market, you have a choice. You can try to figure out which are the best stocks, make a portfolio of them and hope for the best. But the odds of getting the 5 or 10 best ones out of 100 is very difficult, because we have the Magnificent Seven now, and they're not going to be around forever. This is the Mag 7 bar chart from the bottom of the market in October of 2022 through yesterday night. And you see on the left the big monster NVIDIA. And the only other stock of the Mag 7 that beat the ProShares TQQQ, which is the second from the left, is all the way on the right, Meta. Every other one didn't do as well. So NVIDIA was up about 1,374%. The ProShares TQQ was up 412. Meta was up 476, and all the others were up a smaller amount. So you can see NVIDIA really blew out everything.
Mm-hmm.
And even though Microsoft, Apple, and the others are there, they didn't do as well.
And the key point here is that, yes, those individual stocks performed extremely well, but you can kind of traders, both of all time frames, swing to position traders, can use the TQQQ to get very good performance, and it will kind of do that during those strong uptrends during bull markets. Is that right?
Correct. And I want to show you the last one of this group,
Mm-hmm.
Berkshire Hathaway. Everyone thinks Berkshire Hathaway is such a tremendous company. Well, it is a tremendous company, but here it is from around 1999 compared to the Qs
Mm-hmm.
and to the S&P. So just the QQQ itself, which is the blue line on top, did better than Berkshire Hathaway since 1999. But I also want to mention to you that since 1964, Berkshire Hathaway has gone up 5.5 million%. I'll repeat that. 5.5 million% since 1964, which has creamed the S&P index. However, recently, as you can see, it hasn't done as well. So that's why you have to do your homework. I mean, if you can buy QQQ, which is 100 stocks, compared to holding one, even though that has many, many companies built into Berkshire Hathaway, you could be better off. So I just wanted to bring that point home.
Yep, for sure. And one thing I wanted to just to kind of bring it down to the foundational level, would you mind talking about what the TQQQ actually is and how they achieve their kind of 3x the typical QQQ index?
Well, the QQQ was developed in 1999. It's 100 stocks out of the NASDAQ composite, which is about 3,000 stocks. It's selected based on its market cap. The largest market cap companies were extracted from the NASDAQ composite, put into a separate index, and it's called QQQ. And that index has actually 101 companies in it because there are two different share classes for Google. Okay, the expense ratio on that is 0.20%. So it's a very low cost item. One critical factor that many people don't realize is that at the end of each year, the QQQ is reconstituted, meaning that certain of the components are taken out and certain new ones are put in. So recently, in December of last year, they put in, let's see, what is it called? A Palantir. Palantir was put in. So talk about a lucky guess to put in something like that. So they do about 3 to 5 stocks a year. So the beauty of that is that the index keeps getting fresher and fresher with very good growth companies. And it's a growth-based index. The other critical factor I want to mention to you is that there are no financial stocks in this index. So it's everything but financials. Mm-hmm. So there are a lot of stocks in there that are tech-oriented, probably 50%, but there are some healthcare companies, some consumer cyclicals, and other types from other sectors, but it's heavily tech-focused. And the QQQ currently, since 1999, is up 1,550% compared to the S&P, which is about up 742%. So there's a huge difference. It's a double. Mm-hmm. Now, one thing also is the QQQ has $366 billion in assets under management, which happens to be the 5th largest among all the 4,300 ETFs out there. And as far as daily trading volume, it's the 11th largest at currently 40 million shares. So that's the story with it. It's very active. It's heavily used by traders and institutions. And it just moves very well. It's very liquid. It's very transparent. The spreads are a penny. between buy and bid and ask. So it's a great vehicle to use.
And then the TQQQ aims to achieve a 3x return on the QQQ, both to the upside as well as, of course, which is the big drawback, the downside. Is that right?
Right. Just to expand upon that, the 3-time ratio is only valid for 1 day.
Mm-hmm.
In other words, that's what's guaranteed. It's a 1-day guarantee that if the index, the QQQ, goes up 1%, the TQQ will match it. But at the end of each day, they recalculate and recalibrate that. So if the TQQ or the QQQ has a flat market or a down market, it starts compounding in a negative way. And that's when you have problems, because it really goes down very quickly. Also, the TQQ has a 0.84% expense ratio,
mm-hmm.
which is 4 times that of QQQ. That's not unusual in the case of a leveraged ETF. Currently, their assets under management are about $26 billion, which is only less than 1/10 of the QQQ, but it's 6th in trading volume, 53 million shares a day for the TQQQ. And since February 10th, 2010, when it first came out, it's up 23,912%. Compared to the QQQ, which is up 1,445%, and the S&P is up 705%. Now, two things I want to mention. First of all, when the market had its big drop this past year between February 18th and April 7th, the TQQ went down 61%. So you need a seatbelt and a helmet if you're playing that, or you have to have better rules so you don't take that tremendous drop. However, since April 7th through last night, the TQQ is up 135%. Also to be recognized is that during big market drops, this security gets destroyed.
Yep.
And if it were around during the crash of 2000, anyone who put a penny into it would have lost it all. It went down 99% during that crash. And that, we can't really replicate that now. We can just go back and use a simulation because it only existed since 2010. But it was down 81% in the crash of 2022. 81%. And it's hard for people to sit through that. That is why you have an option of doing the SQQQ.
Yep.
And the SQQ is interesting. Just show you that. This is just a recent chart over the past year.
Mm-hmm.
Depending on your perspective, it's a beautiful chart or it's a total disaster. So if you are smart enough in January or February to pick some up, it went from 27 to 65. And then that one day, April 7th, or the day after the crash there, look at that big red candlestick. And then it came right down, and it's $17, $18 a share. This is the triple leveraged bear ETF, the opposite of TQQ. This is only viable during bear market situations, and unfortunately, you got to be very nimble because bear markets are very rare. They're fast and furious, and then the rebound is rapid, as we've seen in the last 2 V-shaped recoveries. If you are there during a V-shaped recovery and you have this in your portfolio, say goodbye to 25% of your money in one day.
Yeah, and
also,
all these... yeah, please. Sorry, Les.
No, last statement is this SQQ has had reverse stock splits. Because it gets so low in price, it was down to $6, $7, or $8 a share years ago. They had to reverse it up 10 to 1. And they did it 3 or 4 times already, because this thing's is going to go to zero in bull markets. So some people play SQQQ, probably only the very nimblest and smartest, and people that are, well-heeled with reserves, because look at the volume here in April. Look at this thing. You know something's going to happen in the opposite direction. It's a big upsweep, but then a complete collapse. That's why I didn't spend too much time on it in the book.
Yep.
Because 75% of the market's years are up years. So why play against the tide? You had a question, Richard?
Yeah, just, both the discussion on the TQQQ and SQQQ, they're liquid, they're volatile, they're great when you catch the trend the right way, but that's why it's important as well to have strong rules behind it, and we'll discuss some of the strategies that you explored and researched in the book, because you don't want to be there when the tide turns and it's going against you. So to start with, I'd love to hear your take on, what kinds of traders would benefit from focusing on these instruments. What experience level do you kind of need? What are kind of the base things that a trader should be able to do before, looking to trade this or use it in their portfolio?
Well, if you want to trade the TQQQ or any leveraged ETF, the first thing you do is do your homework, as Jim Cramer says in general. And that means go to the website of the sponsoring company and read the prospectus, and read the summary prospectus, and look at the fact sheet, and see what the risks are. They lay them all out in the prospectus. That's doing your homework. Secondly, put up a chart for the full life of that ETF and look at it, daily, weekly, and monthly chart. Throw some moving averages on it. See how it moves. Then you can start comparing them. For example, you may want to use TQQQ, but also you have to be aware there are others out there like TECL and SOXL, which is the triple leveraged semiconductors, and many others. One popular one now is TNA, Thomas Nancy Apple. That's the triple leveraged small cap ETF. And all of a sudden that's being awakened because the small caps have gotten killed over the past couple of years. So TNA has had a good run recently. So once you see what the charts look like, start getting your act together and put it on a chart, put your indicators on it, and put $1,000 in an account. And start day trading it and see how it works and how you do. And you'll know very quickly if you can handle that, because you can paper trade it, but there's no pressure psychologically. So day trading is great, but that's not the beginning. You have to trade actual money at risk, and you'll know how your body reacts to that. And then you can start adding a little more money to it, and keep going along. But make sure you have the critical factor in the top of your mind, which is cut your losses short. That's what Mark Minervini does. That's what the top traders do in the Market Wizards book. That's what every smart person does. I didn't do that a few times, and I paid dearly for it. I said to myself, this is a short-term situation. It's going to come back. Good luck. It didn't come back. Then instead of being down 1,000, you're down 20,000. It's an expensive lunch that you didn't have to take. So, and again, the average person shouldn't be trading TQQQ. You've been around a while, you know what you're doing, you have your technicals, you have a good track record, you have a ratio of wins to losses of at least 2 to 1, especially on the dollar side. In other words, you should try to leverage up your risk-reward ratio. A lot of the top traders use a minimum of 2 to 1, and a lot of them use 3, 4, or 5 to 1 because that's what they want to get. They want the odds in their favor. Yep. So I would say if you have 100 traders in the room with experience of 0 to 10 years, probably 5 of them should get involved.
Perfect. And yeah, I'd echo that because when the QQQ is gapping down on news 2%, the TQQQ is going to be gapping down 6% on you, and you got to be able to deal with that and make sure you've got hopefully a good profit and you entered earlier in the trend to handle that. Les, I'd love to dive into now the strategies that you've researched and investigated in your book. Do you mind giving maybe an overview of the process that you use to kind of pick the ones that you'd investigated, and maybe kind of start high level, what kind of main categories of strategies you looked into for this book?
Well, in the book in general, I used a moving average approach, 200-day, 225-day moving average approach over time with the QQQ and TQQQ. It did not work as well with the S&P and the Dow, by the way. So that only worked better with the QQQ because of its volatility. I also used a relative strength approach where you have a portfolio of, say, QQQ and IEF, which is a short-term treasury, and you put it in a portfolio and you measure the performance over a certain period of time. I particularly like using a 3-month time frame, and then at the end of each month you decide based on the prior month's performance if you're sticking around or switching out. So that is an interesting strategy. I also
are you looking to catch momentum there, or are you looking to rotate into a ETF that hasn't been performing as well there?
Well, you can set it up as a portfolio. So you can set up a portfolio of, say, 10 ETFs if you want, and pick the top one. You can use 5, or you can use 2. Like I used QQQ and IEF. I just had 2. I either want to be in or out. And if I'm out, I'm in a bond. So it's a pretty simple strategy. So that works pretty well. Now, I wrote a previous Kindle book called Profiting from ETF Rotation back in 2011. What was interesting is I tried different rotation strategies, some using even all the sectors, the Spider's 11 sectors, putting them in a portfolio, picking the top 1, the top 2, the top 3 each month based on the strongest, and then at the end of each month, redoing the calculation, seeing which are the strongest, and then switching to those. For some strange reason, it worked between 2000 and 2014, and then it stopped working well. Now, how is that? I don't understand that. So I may have an 8th book in me, which I'm not going to tell my wife about, on the sector rotation strategies, because I like that approach. I mean, if you can only deal with 10 different sectors, and you can pick the strongest sector and do well with it, it's pretty simple. Because I don't know if you realize it, the difference between the top sector and the Spider's 11 and the bottom sector is probably 35 percentage points performance between the top and the bottom one each year. And if you were to look at a chart of how they look on, it's called the Callan chart, CALLAN. It shows you by year all the sectors in different colors. You see the variation where everything's jumping around. Certain times you have the large caps with large cap sector ETFs doing well, or that sometimes if you do style or international, you can put anything you want in your portfolio and see how they're doing. And the sectors move around. Sometimes tech is best. Sometimes oil is best in the XLE sector. So it's interesting to do that. Another strategy is a seasonal strategy. Many people are familiar with the Stock Traders Almanac with Jeff Hirsch. He has a best 6-month strategy on the measures based on the Dow Jones Industrials. You're in there between between November 1st and March 31st, and during the other half of the year you're in cash, and that has done very well over the years, and it's beaten being out of the market during the bad time, the bad 6 months. And then he also did that with the NASDAQ. He has a NASDAQ 8-month strategy where you're in the NASDAQ for 8 months, and the other 4 you're more in a cash type of an item. So those have worked well. Of course, it doesn't work every particular year, but the beauty of the seasonal strategy is you can be out of the market for a large percentage of the time. So therefore, your risk reward is much better. And also, every stock and every ETF has its own seasonality.
Mm-hmm.
You can go back 10 or 15 or 20 years if it exists for that long. And on stockcharts.com, you can put it in as seasonal test, and it'll show you by month from January through December what the percentage change was. You can go back 1 year, 5 years, 10 years, 15 years, and you can see certain months are better than others. And the worst month as far as total performance is September. That's the weakest month of the year over time, generally speaking, and it's down about 1 or 2% on average. Of course, we all know that October is not so beautiful. We've had a couple of crashes end in October, and October is known as the rebound month because that's when things usually turn around and do very well. So those are a couple of the strategies. And there are many others out there. I use some strategies from a software package called VectorVest, which has strategies that you can use. Wall Street IO has strategies. I used different strategies from different subscription software because they turned out very well. So people have a choice. And anything that I recommended in the book, as far as those strategies, you can get a trial subscription very free, for very low cost if you're interested in any of those strategies. So those were just a couple of them.
Yeah, focusing on the moving averages strategies for the TQQQ, what were some of the best findings that you were able to come up with in terms of what moving averages to use, whether to do it on the day of the crossover or wait until the end of the month to make any portfolio adjustments?
Well, in the TQQQ, I used like 225 days, and you want to do it at the day of the cross instead of at month end because the results are much better. Mm-hmm. So you have to look at each one. I used a program called ETF Replay, and it showed the results very clearly. Let me see if I can pull up something for you on my screen here. There it is. Okay. TQQ and TLT. Even though it shows a starting date of 3000, it's going to go to the first date that it has data for. So I don't have to even bother changing that. I'm going to change the benchmark. I'm going to first use TQQ as the benchmark, which is a tough benchmark to beat because, it's unbelievable. I'm going to show you that one first. Okay, so it's from February 11th, 2010 through September 4th, probably today's close. The blue is the buy and hold. The green is the strategy, the switching strategy. Switching strategy 7,700% versus 20,000, but the volatility is less. It's still pretty.
Is that volatility maximum drawdown? What does that volatility actually mean?
That's the maximum draw. Well, I'm not sure exactly what that definition is, but the maximum drawdown is right down here.
Gotcha. So it does a better job of capping that, yeah.
Yeah, it's huge for the TQQ. By itself, it's a buy and hold. That's why no one would do that. Well, how did this perform? Let's take a look at the... So you could see here that the TLT was held for 1,260 days, whereas the TQQ was double that. And here's the performance by total return, dividends included, by year. This is the strategy is here, which is switching. And this is the TQQ by itself, buy and hold, doing nothing. You can see what's interesting about TQQ. Look how many years it has triple-digit returns. 1, 2, 3, 4, 5. Look at those monstrous returns. Where are you going to do that? Good luck doing that with a single stock. So that's why it's amazing. But the other part of the coin is you have to be careful that you don't get hit with drawdowns. Now over here, all the trade history is shown, every single trade from the beginning all the way through. A lot of trades. A lot of trades. Now what I want to show you is if you want to compare it to the QQQ, because maybe that's what I did in my book. I wanted to use that as a benchmark. It's a more realistic benchmark, but some people may want the other one to be, apples to apples. So I'm going to run this back test with the QQQ. See how that comes out. Okay, so there it is. Look at this. Compared to the QQQ, 11,000%. However, the drawdown is 35.8%. The volatility is higher, and the maximum drawdown is a little worse. So if I'm going to buy one or the other, where the numbers of maximum drawdown is the same, I'm going to go for TQQQ, where the reward is much higher. Now I just want to mention something. Even though the maximum drawdown is large and the volatility is large, look at the actual returns of each transaction, and you'll see that they're not so large. A couple of percent here and there. You see this column here. That's for the month. Okay, a couple of big pluses here in 2008, probably after the crash. Okay, here's a nice bunch of winners in 2010. Let's see, 2008. Do we have any big drops? See, no huge drops in 2008. See where the market really took a big hit? Let's go down further. Oh, 2013, look at this. Over 4 months here. Where it did get hit. 2015, right here, 2015. This was a rough period here, but look at this. 2020 is a prime example. 3 months here, look at this, about over 70% in 3 months, and then you lost 28%, and then you gained 34%. So timing is critical. You better be on your toes. And you have this big stretch here. Yeah, of course, the 2022. Look at this. Really a bad year. So that's where the maximum drawdown comes. So you're looking at 1 year out of the last 15 where you had the maximum drawdown. So don't get thrown off by the maximum drawdown and just eliminating the consideration of the strategy. Look at the actual losses and gains of the strategy.
Would adding a moving average restriction, only
I tried a
above the
moving average filter, and it didn't help. What would you like to use, Richard, as a moving average? Pick one.
If it's monthly, I think you use 20 in your book, if that's right. Maybe we'll show that.
Okay,
yeah.
20
and
months.
Obviously there's a trade-off between trying to overfit and get too restrictive versus
Right.
using something that'll actually work going into the future. So
right, I never used overfitting because it does, you get a tremendous strategy. It's never going to work in real time. So I'm going to put 20-day moving average and see if that filter helps. Remember the number here, 11,131, and the volatility 36. Remember those two numbers. Okay, here we go.
Yeah.
Okay, we just lost 9,000 percentage points.
Yep, and volatility didn't change much. So
correct.
Yep.
So I tried all kinds of different things, different lengths. I tried different filters. Rotate. I can do it quarterly instead. Let's try that one quarterly for a moment without the moving average. What if we did the quarterly rebalance? Okay, we lost 8,000 percentage points. What if we did it faster than monthly, semi-monthly, every 2 weeks? Not good either. You see?
Yeah.
That's why you have to, I found doing this, I've done hundreds of these tests. Monthly is the best, and I use 3 months. A lot of the literature says use 6, 9, 12 months. I haven't found that to be useful. If you use 12, for example, I can use a look back period of 6 months here. And let's just see how a 6-month strategy would work. If you just basing your test on the last 6 months of performance. Okay, 2,300.
Mm-hmm.
And if you based it on the last 12 months, which I'll do, and then that will be the end of this test. In other words, you're waiting, using data from so old that it's not helping you. I must have done thousands of these tests over the years. Look at this thing, 1545. Look at this disaster.
Yep.
So I did the best I could. I made it simple. And that's one example of a strategy.
Yeah, and thinking out loud, Les, adding the moving average filter might actually decrease the, it might decrease the potential of the strategy, because a lot of the big returns in the TQQQ are on the snapbacks, and those often occur close to or around those moving averages. So you might be eliminating a lot of the snapbacks that, if it caught it, contribute to that great performance. So that might be why adding that moving average filter on top of it, depreciates the performance so much.
And also, if you're very far away from it on the upside, until you cross it on the downside, you're giving 10 to 15% back.
Right.
So it hurts you both ways.
Yep. Fantastic. And would you be able to talk a little bit more about the MACD plus the 6-month strategy? Because the seasonality discussion, I think that's a great one.
So Jeff Hirsch, in his book Stock Traders Almanac, uses the best 6-month strategy, where he buys from November 1st through April 30th, and then he sells April 30th and puts it into cash. So Cy Harding, who used to be running a newsletter service, he passed away about 10 years ago, suggested that Jeff use the MACD indicator to improve it. So actually, I have the Stock Traders Almanac here, which I've been getting for the last it's in its 59th edition. Jeff Hirsch's father started the business, and he had a lot of good strategies. So I'll just mention to you. Okay, with the best 6-month strategy with the MACD indicator from 1950 through 2023, from November 1st through April 30th, starting with a $10,000 investment, ended up at $3.9 million for the 50 years between November 1st and April 30th, using an MAC indicator to pick the exact date, near November and near April. On the other side of the coin, May 1st through October 31st, that strategy lost $5,367 during those 6 months. So the good months, they earned 8.9% average per year, and the bad months minus 0.6%. Now, obviously, there are going to be years between May and October which are positive years. Nothing is perfect. In other words, for the November to April strategy, 53 of the years were up years, and 11 years were down. Okay? Whereas in the worst 6 months, 42 were up and 32 were down. Now also, Jeff did something with the NASDAQ, a similar strategy with the NASDAQ, but instead of using 6 months, he found that 8 months was better. So he did this strategy from 1971 through 2023. And during the November to June period, that's the 8 months he uses, the strategy gained $3.4 million, starting with 10,000, and ended the bad months between July and October 31st, lost $5,400. So again, it's the same scenario. The best months did better than the worst months. And of course, sometimes it wasn't a perfect situation. But overall, for a person that wants to do pretty well with half the risk, it's certainly an interesting strategy.
Yeah. And in the book, you look into adding a MACD signal on top of that to kind of further
that's what the MACD I just gave. Oh, that's with the MACD. Yeah.
Gotcha. Yeah, perfect.
It's a simple thing. It improved the strategy by a few. Let me just look at the original best 6 month strategy without the MACD. Let's see how that did. Okay, the original 6 month strategy, instead of gaining the 3.9 million, which with the MACD, without it, it was 1.4 million. That shows you again, market timing is critical. It's interesting on Wall Street, you keep hearing, don't time the market, it's time in the market. As far as I'm concerned, I think Paul Samuelson also said, try to be out of the market as much as you can because bad things happen. That's paraphrasing his quote. And I believe that too. The less you're in the market, the better, especially if you're a trader. Or you can go into cash, or you can try to go short if the market is reversing. And what I like to use, I have a chapter on technical indicators. My primary indicator for knowing when to be in or out of the market is the 20-day moving average. I have other indicators surrounding that, but that's the critical primary indicator. If I'm below the 20-day, I don't want to be long. Some people like 50 or 100 or whatever they want. It's up to them how they handle it. But each selection of what you do entails another degree of profit you're going to lose if it's too wide of a variance in what you choose as a moving average. A lot of people use... Yeah, go ahead, I'm sorry.
No, just going to say that's interesting because my main filter is the 21 EMA. So basically the exact same moving average that you're using because 20, 21, EMA, SMA, it's going to be pretty much the same signal.
I just want to show you a chart. This is the QQQ through September 3rd. And I put on it an 8 EMA, the green line, the 20, the 200, RSI of 14, MACD standard default settings, and you could see how beautifully it hugs the 8 EMA. And there was a fellow you may not be aware of who passed away in the past few years who did a lot of work with the 8 EMA. His name was Steve Bigelow, Bigelo. He had a website and a service, and he called the 8 EMA his T line, like letter T. He felt that was the moving average in the sand that's critical for him. If you're below the 8, you want to be out of there. So look how beautifully this thing operated here. And see, if it didn't pierce the 20 here. You're still in, even though you had a sell on the MACD indicator. Okay, you didn't sell here. You sold here, but you're back in over here, and then you sold here, and then you're back in. So this whole period, by the way, from beginning of August, we're in a zone here, a rectangular zone. And we're going to break out of this one way or the other. And you can get a million people's opinions. It doesn't mean anything. The matter is what happens, actually happens. I know Brian Shannon, who uses the volume-weighted moving average, he uses a 5 EMA, I believe.
5 SMA, I think. Yeah.
He uses a 5 SMA, so he's even tighter to the price. He doesn't want to be around if it's below the 5, among his other indicators.
Question for you, Les. So the 20 DMA for you, Is that saying you're not going to day trade the TQQQ or QQQ above that, or is that for a longer term strategy that you're also using in your portfolio?
I don't use any long-term strategies in my portfolio. Everything I have is day traded, including retirement, which is unusual, but probably not too smart. But I don't use the 20. It's just one of my indicators on my multiple chart, because don't forget, if I use a Keltner channel or a Bollinger Band, the 20 is the middle line.
Right.
So it's there anyway. But I don't use that as my critical thing to sell. I wait for the other indicators to indicate together that there's a sell signal. And I put Keltner bands on, or Bollinger Bands as well, and that seems to work pretty well.
And that would be on an intraday time frame,
so
of course,
for most people, I would suggest that 20 is a very critical number. Once you break the 20, as we have back here, and before that, you don't want to be around. And then the 8 is coming up here, but it couldn't break the 20. You don't want to invest again. You think it's a breakout point, but it's a fake out. And over here, this is a big mess over here. You have to be very careful here. Look at this bar, this white bar, it's huge, but then it gave it back. But here's the point where you buy on this chart, right over here. Because then you got the MACD confirmation. You had the RSI about a week earlier. The thing down here is the NASDAQ, the percentage stocks of the NASDAQ index above the 20-day moving average. And you could see when things get very low, say below 20, that's a very good buy point. And also I should mention to you, it's much easier to determine market bottoms and market tops.
Mm-hmm.
Much easier. I don't know how many times I tried to predict the market top based on the indicators, and it didn't work. I thought this was going to be a market top right here. It faked me out. I thought this would be a market top. I was right for about a day and a half. Now we're up here again. But now we have a lower low, a lower high. This is not looking good over here. But we did 200 points today, so it's not on this chart yet. So we're above up here again. It's unbelievable.
And that's because topping is more of a process that can take weeks and months versus, a bottom is much more violent, more of an event, and is a little bit easier to spot on the charts, at least for me personally.
Yes, but most of them are not necessarily violent. You're probably not aware of the fact that in the crash of 2087, October 22nd, that was not the low of the market.
Mm-hmm.
It was down 22% that day. I think the Dow or the S&P. The low that year was December 3rd.
Mm-hmm.
And the indexes were up for that year, believe it or not, because they had a huge rise up and through August and early September. So you really have to be careful. Also, people thought that the market in 2000 and the 2007 and 8 crash, they thought it was over at the end of November of 2008. Guess what? It crashed back to March of 2009. Turned out to be worse because they had another bottom there, another leg down. So just because it's, and that also, the crash, the market rebound in 2022 and this April and in 2020, the V-shaped, those are very rare. The problem is people are now used to them because they've seen a lot of them. They've seen 3 of them in the past, say, 5 years, so they think it's common. That's not necessarily to be seen like that in the future. I'm concerned about the market in 2026, when things may get worse for a lot of reasons, economically, politically, and otherwise. We have to be very careful here. I also follow cycles. There's a very good website that your viewers may be interested in. It's called Foundation for the Study of Cycles. It's on the YouTube. They have a broadcast every Monday. It's free. Foundation for the Study of Cycles. and they show you their cycle tool, and they show you cycles for the indexes, for some stocks, for Bitcoin, for some economic factors. It's very interesting work. And cycles do play a major role in investing, especially on the commodity side.
Over the course of your career, Les, I've talked with Stan Weinstein and a few other traders who have been doing this for decades. Have you noticed any significant changes in cycles or how the markets operate? A lot of them seem to say it's kind of the same, but it's just a little bit faster. The pace is a little bit faster over time. What have you made any kind of similar observations yourself?
Yes, I would say all the psychological factors are the same. All the technicals are the same. It's just that the news cycle is multi-second cycle, where we didn't have the internet. We read stuff in the newspaper.
Yep.
When I first started out, I was reading the stock prices the next morning in the newspaper. Look where we are today. You get free real time today. When I was trading back in the early days in the 1988 time frame, I purchased a satellite dish and put it on my deck outside my house to get real time. Ridiculous. Also, back in the 50s, the only thing available to buy were mutual funds and stocks. And the brokerage houses only sold active mutual funds with a commission up front called a front load of 5 to 8%.
Wow.
So in those years, the brokers had the yachts.
Yeah.
And they did. I remember my grandmother, when she bought $10,000 worth of stock, she was charged $200 commission. And the broker was putting her into IPOs. He'd be arrested today. She was 76 years old. He's buying IPOs for my grandmother? Ridiculous things that they did. And also the largest price stock back in the 50s was Superior Oil of California, ticker SOC. It was $1,000 a share. And there were very few stocks were over $100. And I used to know the names of all the stocks. I used to see them every day. Now I couldn't. It's just impossible now. And by the way, I heard an interesting statistic. There are more ETFs out than stocks on the market as of
Really?
a week ago. 4,333 ETFs are larger than the number of stocks out there, because a lot of stocks collapsed over the years or merged out of existence.
And now there's all these double and triple Tesla ETFs and stuff like that too.
Things are going crazy now. They're trying to come out with all types of hot sauce and hot juicy stuff that if you're on the wrong side of, you'll be paying dearly.
Yeah.
You probably have 200 single stock ETFs now with leverage, up 2x. And those are the high flyers as far as volume. And they keep coming out every day. Granite shares and others are coming out. They're also coming out with active ETFs. They're about 40% of the new issues coming out. And the statistics and data from Standard & Poor's in the report called the SPIVA report, SPIVA, shows that over time, 5, 10, 20 years, the active managers, 95 to 90%, do not beat their benchmark. So why would anyone buy an active ETF? And why would the sponsors keep coming out with them? Well, there's only one place where that will be a good place, and that is in fixed income. That's a more complex market. Active in those markets may have an edge, but certainly not in the regular world of active stock trading, because the bogey is their expense ratio is high, and a lot of them don't necessarily use technical analysis, and they move slowly, and they always have to be 100% invested. It's in their prospectus. If you're a manager of a fund, that's to say a growth fund, you can't take 50% out and put it in cash. It's not permitted, so you're going to get hit in a bear market. But in any event, the trader of today, the investor of today, has everything at their disposal. Mm-hmm. Very cheaply, the beautiful software out there. If you're interested in ETFs, you can go to ETF.com. It's a subscription in certain respect. It's not a lot of money. I use ETFaction.com, ETFreplay.com. There's many of them I listed in my book too. There's 10 or 20 different sites you can go to. ETF Screen, ETF.screen is free. It ranks all the ETFs based on a number of variables. You can go to it, see what's working out there. A lot of different things you can do.
Yeah, excellent. And Les, you end chapter 8 of your book with kind of 17 key trading guidelines, which I thought all of them were excellent. I wanted to ask you, and you can take a moment if you need to, in your view, if there are kind of 3 of the most important ones for traders to internalize to be able to do this for decades, because obviously the goal is not to be a flash in the pan trader. That's not how you get the long-term wealth building benefits. We want to be doing this for years and years. So I was curious if you had 1, 2, or 3 favorites of that list, though I think all of them are really excellent.
Oh, yeah. Well, number 1 is always number 1. Cut your losses short. And if you don't follow that rule, you'll be out of the business very quick. That's every trader will tell you that. And it's not to be neglected because you may not believe it. Don't let your profits turn into a loss as part of that. If you're up $1,000, there's no reason you should be, at the end of the day, down 1,000. At worst, you should be at 0. So that's very important. Dollar cost averaging is really problematic, especially if you're trading stocks, because you never want to go to dollar cost average in a stock that's declining. Because, yeah, you want to get back to even, but that stock can go to 0. Look at Enron, look at Polaroid, look at Xerox, look at Kodak, look at Citibank, look at GM over the years. If you want a dollar cost average, wait till it turns around and goes up, and dollar cost average in an index fund, an ETF, a mutual fund, not in a stock. It's too risky. I suggest market timing, because every time I read something from the Wall Street firms, don't time the market. Everyone says, 99.9% say don't time the market. Well, what's your other option? Buy and hold? Fine. If you want to buy and hold for 30 years and you want to buy index funds, that's one strategy. But if you're in the market and you want to do other things and you don't have that longer time frame, you better market time, because you're going to take some big hits when bear markets hit, unless you have a strategy that gets you out. So that's very important. Use technical indicators, because how else are you going to do it? You're going to guess, you're going to ask your friends, you're going to watch Kramer, you're going to listen to some guru on Wall Street Week. Just turn the TV off. Develop a plan. Use indicators. Be smart. Just do the best you can for yourself, and find a strategy that works for you, and just work with it. Try to be a specialist. I'm a specialist. I trade one thing. I don't have to worry about anything else. I look at one chart, I make my decisions, I close my computer, and I wait for the next day. Some people like to position or swing trade. That's fine. Just have your rules in place. The minute you buy something, put your stop limit order in. And I'm suggesting a stop limit, not a stop order. If you have, for example, if stock's at 100, you put a stop order in at 95. It gaps open the next day at 90. You're sold out at 90. Instead, use a stop limit order at 95. It gaps down the next day to 90. It doesn't take you out yet. You have a chance to then decide what you want to do with it. It may bounce back up to 95, and then it'll sell you out on the way up because the order's it. But at least you know what you're protected. So be careful of that. Also, don't get involved in taking advice from TV. The guys on TV, everyone has an opinion. It doesn't matter. No one knows what's going to happen in 1 minute, 5 minutes, a year, or next year. I look at numerous stock forecasters. Every year they come out in December for the next year. they're off by miles. And 99% of them are bullish every year. Well, every year is not going to be bullish. This past year, in 2024, the forecasters had to revise their forecast 5 times. Because every time they said something, the reverse happened. So, develop your own trading plan. Do a back test before if you can do it. Put a small amount of money in if you're new to it. Add money as you get better. If you have a lot of trades that you're losing on, just take a break and try to learn. Read books. There are a lot of good books out there. Bill O'Neill has very good books. The whole series of books. Read Jesse Livermore's book. Mark Minervini has terrific books. William O'Neill, Stan Weinstein, Marty Zweig, Charles D. Kirkpatrick, he wrote a book on technical analysis. Jesse Livermore, How to Trade Stocks, a book on psychology, Trade Your Way to Financial Freedom by Van Tharp, that's VANTHARP. Read books on trading psychology. Some people believe that psychology is more important than anything else. Because if you're an emotional trader and you get frazzled very easily, you shouldn't be trading. You should maybe do something else that's longer term. Day trading is the most difficult trading to do. 95% of the people fail in the first year. The problem now, you have sites, Robinhood, where you can do trading there and buy all kinds of meme stocks. Yeah, it's great until it goes against you. You want to play with crypto? Go ahead. See what happens. You'll be holding the bag at the end when the institutions dump it. So who knows where crypto is going? I heard estimates of $1 million on some of the prices on Bitcoin. It's 117 now. Yeah, it could be $1 million maybe in 10 years. It could be 50,000 in 2 years. But the fact that the administration's pushing it and they're involved in it personally, it has support at this point in time. But there's a lot to learn in the market. If you don't want to spend a lot of time in the market and just want to have it, you want to do well, just buy yourself a handful of ETFs that don't overlap each other. You can buy the Vanguard. You can buy an S&P 500. You can buy a QQQ, buy a section of QQQ. Actually, in my last chapter of the book, I recommend buying and holding the TQQQ, which I never thought I would do. And the reason I mention it is because the tremendous performance it has had over the years, knowing that it had huge drawdowns. But I mentioned only put a small percentage of your money in if you're interested, between 1% to 5%, and try to get in initially on at least a 25% drawdown, and hold it for at least 10 years, but preferably 20 or 30 years. Wouldn't it be nice to buy something for your grandkids or your children, put 5,000 or 2,000 in, and let it sit there for 20, 30, 40 years? At worst, you'll go to zero, but look at the upside potential. So, and the QQQ is a great place to be for innovative companies based on the changes we're experiencing in artificial intelligence. It's going to be a new world out there. It's going to change everything, some for the good, but unfortunately we have bad actors, and that's the problem that has to be resolved and taken care of. So it's a wonderful world out there. A lot of interesting companies in the NASDAQ 100, including Costco. Costco is in there, and other companies that you wouldn't imagine are in the NASDAQ 100. So check out the NASDAQ 100 index. Look at the 100 companies, see if you're interested, and perhaps consider a larger portion of the portfolio in that. Don't forget, if you own an index fund like a Vanguard or an S&P 500 fund, probably 1/3 of the portfolio is in the top 10 stocks, which are the Mag 7. The Mag 7 will always be around, and some of them are doing better than others. You have 2 or 3 that are doing better than the others right now, but the others may come back, and new ones are going to be coming in. So we're in a technologically oriented world. that's where you should have a portion of your money for future growth. And that's my message.
Excellent. Well, Les, this has been fantastic. I've learned a lot and gotten some great ideas talking with you as well as reading your book. Where can people pick this up if they're interested?
Well, the simplest place is Amazon. Just put my last name in, Masonson, Masonson, or put in QQQ and TQQQ, and it'll pop up. And I just want to mention it's 8.5 by 11 inches. So you'll be able to read it easily with the type font and the charts. So hopefully you'll pick up a copy. If you like it, write a review. If you didn't like it, don't write a review. And I appreciate your time, Richard. And I think my focus with all my books, by the way, is to educate people. I never had a side product or a service that said, come to my newsletter or I'm selling you some software. The only thing I'm selling you is education. And you should, again, do your own due diligence and check everything out before you put a penny anywhere.
Yeah, excellent. Les, thank you for your time. We'll put the link actually right in the description so people will be able to find it really easily. Any last closing message that you'd like to have to leave everybody with today? What's the one takeaway from today or from your book that you hope every viewer kind of internalizes?
Well, I think you should just be careful. Know what you're getting involved in. Never buy anything that you're unsure of. You don't need a financial advisor for investing. You need a financial advisor maybe for other aspects of your life insurance and financial planning and wills and other kinds of documents. So try to do your own thing. Consider ETFs and just be aware of the fact that we have bull and bear markets. And try not to get caught in the bear market by using a few simple technical indicators, and even including a simple moving average will save you a lot of money. And I wish you all well in your investing and your future.
Excellent, Les. Thank you again for your time, for being here. To everybody watching, I hope you guys enjoyed. And thanks so much for tuning in, and we'll be right back with the next video. Cheers.